Look, I need to be straight with you about something that's happening right now in the silver market. And if you own paper silver, ETFs, futures contracts, allocated accounts, what I'm about to show you could mean the difference between protecting your wealth and watching it evaporate overnight. Because here's what nobody's talking about. There's a massive disconnect forming between paper silver and physical silver. And when this gap finally snaps, and it will snap, one of these markets is going to zero while the other explodes. The question is, which side are you on? Let me paint you a picture of what's actually happening behind the scenes. Right now, the COMEX, that's the Commodities Exchange in New York where silver futures trade, is sitting on about 270 million ounces of registered silver. That's the silver that's actually available for delivery. Sounds like a lot, right? Here's the problem. The open interest in silver futures represents claims on over 900 million ounces. Do the math. That's more than 3 claims for every single ounce of actual metal. It's a game of musical chairs, and there aren't enough chairs. But it gets worse. Much worse. See, most people who own paper silver think they own real silver. They look at their brokerage statement, see SLV, or whatever silver ETF they bought, and they sleep well at night thinking they're protected against inflation, against currency collapse, against whatever financial storm is coming. But here's what they don't know. When you own shares of SLV, the biggest silver ETF, you don't own silver. You own shares of a trust that claims to own silver. And buried in the prospectus, in language that would make a lawyer's head spin, there are clauses that basically say, in certain circumstances, we might not actually have all the silver we say we have, and you can't do anything about it. I'm not making this up. Go read the prospectus yourself. It's all there in black and white. Now, why does this matter? Why should you care about the fine print in some ETF prospectus? Because we're watching something unprecedented unfold in the silver market right now. Industrial demand is absolutely exploding. Solar panels alone are consuming over 200 million ounces a year, and that number is growing by double digits annually. Electric vehicles, 5G infrastructure, defense applications. Every major technological trend of the next decade is silver-intensive. Meanwhile, mine production is basically flat. We're pulling about 830 million ounces out of the ground each year, and that number hasn't meaningfully increased in years. The easy silver has been mined. What's left is deeper, lower grade, more expensive to extract. So you've got demand screaming higher and supply stuck in neutral. Economics 101 says price should be going through the roof, right? Except it's not. Silver is still trading in a range it first hit back in 2011. 14 years later, and we're basically at the same price. How is that possible? The answer is paper silver. The answer is the ability to create infinite claims on finite metal. Let me tell you a story that'll make this crystal clear. Back in the 1960s, the United States government promised foreign central banks that every dollar could be redeemed for gold at $35 an ounce. They printed this promise on the actual currency, redeemable in gold on demand. But here's what was happening behind the scenes. The US was printing way more dollars than it had gold to back them. By 1971, foreign governments started to catch on. France sent a battleship to New York Harbor to pick up its gold. Germany wanted its gold back. The jig was up. On August 15, 1971, President Nixon went on television and, temporarily, suspended gold convertibility. Temporary turned permanent. The dollar became pure paper, backed by nothing but faith and the military might of the United States. Now, why am I telling you this story? Because the exact same thing is happening in the silver market right now. Except this time, it's not governments making promises they can't keep. It's banks and ETFs and futures exchanges. They've created a paper silver market that's dozens of times larger than the physical silver market. And just like in 1971, more and more people are starting to ask, can I actually get my metal? And the answer, increasingly, is no. Let me give you some recent examples. In 2020, during the COVID panic, something fascinating happened. The price of physical silver coins and bars completely disconnected from the paper silver price. You could see silver trading at $18 an ounce on the COMEX, but try to actually buy a physical silver eagle? You were paying $30, $35, sometimes $40 an ounce, if you could even find one. Dealers were sold out. Mints couldn't keep up with demand. Premiums went absolutely insane. And yet the official silver price barely budged. How? Because the paper market kept trading, kept creating new contracts, kept suppressing the price, even as the physical market was screaming shortage. That was a warning shot, a preview of what's coming. Because here's what's different now. Back in 2020, that squeeze lasted a few months and then eased as supply chains normalized. But the structural imbalance we're facing now isn't temporary. This isn't a panic-buying blip. This is a fundamental supply-demand crisis that's only getting worse. China is hoarding silver. Not just buying it, hoarding it. Their imports have surged while their exports have collapsed. They're bringing silver in, and it's not coming back out. Why? Because they know what's coming. They're building out the largest solar infrastructure in human history. They're electrifying everything. And they're not stupid. They know silver is going to be worth a lot more in the future than it is today. India is doing the same thing. Their silver imports hit record levels last year. And unlike gold, which they buy for jewelry and cultural reasons, silver is going into industrial applications. It's being consumed, not stored. Once it's used in a solar panel or a circuit board, it's gone. You can't get it back economically. Meanwhile, Western investors are finally starting to wake up. After years of ignoring silver, money is starting to flow back into the sector. But here's the critical question. Where is that money going? If it's going into paper silver, ETFs, futures, mining stocks, it's not affecting the physical supply-demand balance. It's just creating more claims on the same finite amount of metal. But if even a small percentage of that money demands physical delivery, the whole system breaks. And that's exactly what's starting to happen. Quick aside here, if you're sitting on $100,000 or more in retirement accounts and you're worried about this kind of systemic risk, I put together a free guide on how gold and silver IRAs actually work. It's in the description below. Covers how you can get physical precious metals into your retirement account without triggering taxes or penalties. Worth checking out if you want to hold real assets instead of paper promises. Anyway, back to what's happening in the market right now. The COMEX is terrified. You can see it in their rule changes. Over the past few years, they've quietly implemented new regulations that make it harder to take physical delivery. They've increased margin requirements. They've changed contract specifications. They're doing everything they can to keep people in the paper market and out of the physical market. Why? Because they know they don't have the metal. Here's a number that should terrify anyone holding paper silver. The COMEX has a delivery failure clause. Buried in their rules is a provision that says if they can't deliver physical metal, they can settle contracts in cash at a price they determine. Read that again. If you own a futures contract and you demand delivery, and they don't have the silver, they can just give you cash instead, at whatever price they decide is fair. Think about what that means. You bought silver as protection against currency debasement, against inflation, against the collapse of paper assets. And when you go to claim your metal, they hand you more paper currency, the exact thing you were trying to protect yourself against. It's the ultimate bait and switch. Now, some of you might be thinking, okay, but the ETFs are different. They actually hold physical silver in vaults. I've seen the audit reports. Have you? Have you actually read those audit reports? Because I have. And let me tell you what they don't say. They don't say that your specific shares are backed by specific bars of silver. They don't say that the silver is segregated and allocated to you personally. They don't say that in a crisis you have any legal right to demand physical delivery. What they do say, in very careful legal language, is that the trust owns silver, and you own shares of the trust. And the trust has the right to sell that silver, lend that silver, or do pretty much whatever it wants with that silver. And you have no say in the matter. There are documented cases of the same silver bars appearing in the inventory lists of multiple ETFs. The same serial numbers, showing up in different vaults, backing different funds. How is that possible? Because the silver is being rehypothecated, lent out, used as collateral, counted multiple times. It's fractional reserve banking, but for silver. And just like fractional reserve banking, it works fine, until everyone wants their money at the same time. Then the whole thing collapses. We saw this movie before with gold. In the 1930s, the US government confiscated private gold holdings. They forced citizens to turn in their gold at $20.67 an ounce, then immediately revalued it to $35 an ounce. Instant 70% profit for the government. Instant 40% loss for anyone who complied. But here's what most people don't know. They didn't confiscate gold coins. They confiscated gold certificates, paper claims on gold held in bank vaults. The people who held physical gold in their own possession, many of them kept it. The people who trusted the banks to hold their gold, they got screwed. History doesn't repeat, but it sure as hell rhymes. So what happens when this paper-silver market finally breaks? What does that actually look like? Let me walk you through the most likely scenario, based on what we've seen in other markets when paper claims exceeded physical supply. Stage 1 is what we're in right now. Growing awareness. More and more people are starting to question whether their paper silver is actually backed by real metal. Premiums on physical silver are starting to creep higher. Delivery times are getting longer. But the paper price is still relatively stable because most people are still trading paper. Stage 2 is the scramble. This is when a critical mass of investors simultaneously decides they want physical metal instead of paper claims. Maybe it's triggered by a geopolitical event. Maybe it's a major ETF admitting they don't have all the silver they claimed. Maybe it's a COMEX delivery failure that goes public. Whatever the catalyst, suddenly everyone wants out of paper and into physical. This is when premiums explode. We're not talking about the 20 to 30% premiums we saw in 2020. We're talking about 100%, 200%, maybe more. The paper price might say $30 an ounce, but you can't actually buy physical silver for less than $60 or $80, if you can find it at all. Stage 3 is the break. This is when the paper and physical markets completely disconnect. The COMEX price becomes meaningless because nobody can actually get metal at that price. ETFs suspend redemptions. Futures contracts are settled in cash. The paper market effectively dies, and price discovery moves entirely to the physical market. And here's the thing. We don't know what the real price of silver is. We won't know until the paper market is out of the way, and we're dealing purely in physical supply and demand. But we can make some educated guesses based on the fundamentals. If you look at the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, it's currently around 85 to 1. Historically, that ratio has averaged closer to 60 to 1. In the ground, silver and gold are mined at a ratio of about 8 to 1. And in terms of industrial applications, silver is far more critical than gold. So if gold is at $2,600 an ounce, and silver should be at a 60 to 1 ratio, that puts silver at $43. If we go to the mining ratio of 8 to 1, that's $325 an ounce. Now, I'm not saying we're going to 8 to 1 tomorrow, but I am saying that silver is dramatically undervalued relative to gold, relative to its industrial importance, and relative to the supply-demand fundamentals. And when the paper market breaks, we're going to find out what silver is really worth. Here's another way to think about it. The entire above-ground supply of investment-grade silver, all the bars and coins held by investors worldwide, is worth maybe $50 billion. That's it. For context, that's less than the market cap of Netflix. It's a rounding error in global financial markets. Now imagine what happens when even a tiny fraction of global wealth tries to move into physical silver. There's simply not enough to go around. The price has to go up, dramatically, to ration the available supply. We're talking about one of the smallest, most manipulated markets in the world, facing one of the largest demand surges in history. The math doesn't work at current prices. Something has to give. And when it does, the people holding paper silver are going to learn a very expensive lesson about the difference between owning an asset and owning a claim on an asset. Let me tell you about what happened in the nickel market in 2022. This is a perfect case study for what's coming in silver. Nickel trades on the London Metal Exchange. In March 2022, a massive short squeeze developed. The price of nickel went from $29,000 a ton to over $100,000 a ton in a matter of hours. Trading was halted. Contracts were canceled. Billions of dollars in trades were simply erased. Why? Because the shorts couldn't deliver the physical metal. The paper market had gotten so far ahead of the physical market that when delivery was demanded, the whole system broke down. The LME's solution? Cancel the trades. Pretend they never happened. Protect the shorts at the expense of the longs who had made the right bet. Now, The silver market is much larger than nickel, but the same dynamics are in play. Massive short positions, limited physical supply, growing demand for delivery, and exchanges that will do whatever it takes to protect the system, even if it means screwing over the people who played by the rules. If you own paper silver, you need to ask yourself, when the music stops, do you really think you're going to get a chair? Or are you going to be the one left standing when they cancel the trades, suspend redemptions, and settle in cash? Here's what the smart money is doing right now. They're quietly exiting paper positions and accumulating physical metal. Not all at once, that would move the market, but steadily, methodically, they're converting paper claims into real assets. Central banks are doing it with gold. Sovereign wealth funds are doing it. Family offices are doing it. The people who understand how the financial system really works, they're not trusting paper promises anymore. And you shouldn't either. Look, I know physical silver isn't as convenient as clicking a button and buying shares of an ETF. You have to find a reputable dealer. You have to pay a premium. You have to figure out storage. It's more work. But here's the question you need to ask yourself. Would you rather have the convenience of paper silver or the security of knowing you actually own real metal that nobody can take away from you? Because when this paper market breaks, and it will break, convenience isn't going to matter. The only thing that's going to matter is whether you own real silver or just a promise of silver. Think about what's happening in the world right now. We've got inflation running hot despite what the official numbers say. We've got central banks printing money like there's no tomorrow. We've got geopolitical tensions escalating. We've got a global push toward electrification and green energy that's going to consume massive amounts of silver. And in the middle of all this, we've got a silver market where paper claims outnumber physical metal by orders of magnitude. This isn't sustainable. It can't last. And when it breaks, it's going to break fast. You won't have time to react. You won't be able to call your broker and say, "Hey, I'd like to convert my ETF shares to physical silver now." By the time you realize what's happening, it'll be too late. The premiums will already be through the roof. The dealers will already be sold out. The ETFs will already have suspended redemptions, and you'll be stuck holding paper while watching the physical price go vertical. I've been studying precious metals markets for over 2 decades. I've seen booms and busts. I've seen manipulation and squeezes. I've seen paper markets disconnect from physical markets and then reconnect at vastly different prices. And I'm telling you, what's setting up in silver right now is unlike anything I've seen before. The fundamentals have never been this bullish. The supply-demand imbalance has never been this extreme. And the gap between paper and physical has never been this wide. This is a once-in-a-generation opportunity, if you're positioned correctly. But it's also a once-in-a-generation risk if you're on the wrong side of the trade. So here's what you need to do. Take a hard look at your silver holdings. If you own paper silver, ETFs, futures, allocated accounts, ask yourself, can I actually get physical metal if I need it? Have I read the fine print? Do I understand what I really own? And if the answer to any of those questions makes you uncomfortable, it's time to make a change. Convert paper to physical while you still can, while premiums are still reasonable, while dealers still have inventory, while the system is still functioning normally. Because once this breaks, there's no going back. The people who waited, who thought they had time, who trusted the system, they're going to learn a very expensive lesson. Don't be one of them. The warning signs are all there. The data is clear. The fundamentals are screaming. The only question is, are you going to listen? Your financial future might depend on the decision you make right now. Paper silver or physical silver, a promise or the real thing, security or convenience. Choose wisely. Because in the silver market that's coming, there are only going to be 2 types of investors: those who own real metal and those who wish they did. The clock is ticking, the gap is widening, and when this finally snaps, it's going to be spectacular. In the best way possible if you're holding physical, and in the worst way possible if you're holding paper. Don't say you weren't warned.